So we learned that perfect hedge is when the hedge completely eliminates the gain and loss in the market due to the price fluctuations. We started this with this example and say, okay, assume you are or you work for an oil producing company, and you plan to you know that you're going to have, you know, your production plan, and you know you're going to have 500,000 barrels of crude oil for the market in December. Right now, let's say it's March. You know that you're going to produce around 500,000 barrels of crude oil in the market in December. So your position in the cash market is going to be long. Always, it is going to be long. You're going to be long commodity in the cash market. So the hedging strategy is you have to go to the financial market and sell how many? 500 contracts right now in March, right? Let's go through some numbers here. Let's assume the current price in the spot market is $60 per barrel. December futures contract delivering in December is $61, right? So you will go and sell 500 futures contract expiring in December right now, right? And let's say, let me move on, go to the example here. And let's say time passes and we are getting close to the December, it's November, early November, price changes, and in this scenario, prices go down. Prices go down in the financial market and also go down in the spot market. Why? Because we said the relationship between the spot market and futures we can explain in two terms. Parallelism is when financial market and the spot market are highly correlated. They track each other. They're being affected with the same factors. One goes up, the other goes up. One goes down, the other goes down too. And the other term is convergence. Convergence is for the expiration date. When we get close to the expiration date, these two prices, financial market and futures, they get close to each other. They converge. Under this scenario, so we'll see that it's early November. It is still some time to the expiration date, but prices have gone down. Okay, I'm trying to put the pen. So a spot market has gone down 70 cents. You remember in March, it was $60. Right now it's 59.30 cents. And also in the financial market, prices have gone down to, it was $61 early on in March when we sold December futures at $61. And right now prices have gone down and it is $60.30, right? So this is how we set up the table. As you can see, early on in March, the price in the cash market was $60. So we went to the financial market and we short 500 futures contract expiring December at $61, right? Time passes, it's early November, prices go down 70 cents in the cash market, 70 cents in the futures market. And because we are not interested in delivering the commodity to the Cushing, Oklahoma, we have to close our position in the financial market. Now we are going to calculate the money that we lose in each market. So we learned that because prices have gone down in the cash market, we're going to lose some money in the cash market, right? We are a producer. We aim for $60. Now prices have gone down to 59.30. How much money do we lose in the cash market? 500,000 barrels of crude oil times this difference, 59.30 minus 60 times $500,000, which is going to be minus $350,000. How much do we gain or lose in the financial market? You remember, the position is short. We sold the contracts at $61. Price went down. From the fundamental factors, we know that if we take a short position, we will make money if market is bearish, right? So we sell high, we buy low. How much money do we make? The difference, right? It is going to be 70 cents, the difference between these two, times 500,000 barrels. 500 contracts, 1,000 barrels each contract, so it is going to be 500,000 barrels. So we're going to make the profit of $350,000. And as we can see, these two are exactly equal. So the net is going to be zero. This is called perfect hedge, right? When what we lose or gain in one market equals what we gain or lose in the other market. Okay, let's work on another example. Here we assume from now to November, prices went down, prices go down. Let's assume the other way. Let's assume from now to November, prices go up. Let's see what happens. In this example, we saw that how hedging was successful, helping us make up the money that we lost in the cash market, right? Okay, another example, let's say prices go up. Prices go up to $60.5 in the cash market and $61.5 in the futures, right? Again, we set up the table in March. Right now, the price in the cash market was $60. We had 500,000 barrels of crude oil, and the position was short, $60. Sorry, this should be 61. I should correct this. I think I missed that. Slide number 41. Okay, so the price was 61. The position was short. Now time passes, it's November, price go up, 50 cents here, 50 cents here. Let's see how much money we make or lose in the cash market. So prices go up, right? And we are producer, we are crude oil producer. When price go up, we make money, 50 cents. How many barrels? 500,000 barrels. So we are going to make $250,000 in the cash market. How about in the financial market? Prices go up, right? 50 cents go up. The position was short. From the fundamental factor, we know that if we have a short position, if market is bullish, if prices go up, we lose money, right? How much? The difference times the barrels that we are going to have in the market. How much do we lose? $250,000. Again, in this case, these two, gain and loss, they match, and we end up losing nothing, gaining nothing. Very important point here. If there was no hedging strategy, we could have made $250,000 because prices went up. Now, because we are obligated under this hedging strategy, because we short 500 contracts, we are obligated to, we have to close the position and we lose money. So because we hedged, we lose money. If there was no hedging, there was no loss here. But remember, hedging is not only getting rid of potential loss. Hedging is when you are going to say, okay, I don't want any deviation in my, any variation in my revenue. I'm going to stay with what I planned, and I'm willing to get rid of potential profit as well as potential loss. So this is what we see here. If there was no hedge, we could have made $250,000. But when you are in March, you don't know what is going to happen in November. So you say, okay, I don't want to risk that. I might have, I could make money, or I could lose money. I'm going to get rid of both. In this case, we can see under this scenario, we could have made money, but because we are under this hedge, then we lost some money under the hedge, but they cancel out each other.